Disney is up a lot. It crushed revenue and earnings yesterday in their report. They were expected to make 96 cents per share and have revenue of $21 billion. This is their press release for their investors. Revenues grew 26 and 28% between the last quarter and the last 9 months. EPS was $1.09 versus that 96 cents, and it beat the 80 cents they had in the previous year's quarter. And they did, if you look down here, revenues of $21.5 billion versus the $21 billion expected. So not only that, if you look up here, obviously streaming is a big thing right now. Disney Plus, all their apps. So they added 14.4 million Disney Plus subscribers. They were expected to have 148 million subscribers. They ended up with 152 million. And across all of their streaming services, they're up to 221 million subscribers, which I think, I was a little worried about saying before, but it might be bigger than Netflix right now. And that has been confirmed by the nod that Mo just gave me and the comment that Tim told me earlier. So, guys, Disney was really affected by the shutdown, obviously. All these parks were shut down. It was hard to do everything. So now they're roaring back. So let's go to our software. And remember, if you have our software, please follow along because it's much easier to get used to the software as you do it along with us. So looking at Disney stock, it is still down a lot in last year. Their 52-week high is 187, 52-week low was 92, and they're back up to 118 today. So they're up 5.5% today. Now look at their revenue. Let's go to the income statement and see how their revenue was affected. Oh, wow. Actually, look at this. So over the last 5 years, wow. 57, 60, 78, 58, 77. This was our friend, COVID Carl. We're going to call him COVID Carl from now on. I have no idea why I just said that. But they're obviously soaring. With Disney Plus subscribers, how much is Disney Plus? $6 a month?
Well, they actually raised prices, so it looks like it's going to be between $7 and $10 a month now.
Okay, so call it 7. But you have 200 million people using it. That's $1.4 billion per month in revenue. And I'm quite sure that gross margin is very, very high. This is what I talk about. There's going to be a lot of competition as time goes on. You look back at our videos from years past, I've always talked about that streaming became this big competition thing. There's going to have to be some sort of consolidation, is my guess, at some point in the future. Look at Netflix. Netflix went from growing like crazy to all of a sudden stand still on growth. In fact, they lost people in the last quarter, the quarter before that. So what was Disney's profit? Now, here's the difference about Disney. Even though their revenue is much higher, look at their profit the last 5 years. 11.5, 13.5, 5.4. They lost $4.5 billion, and they made $2.6 billion last year. That's not consistent, right? We want to make sure they get back to these levels of profit. So when we do our stock analyzer tool, which will come towards the end of this video, you'll see our profit margin is very much affected because in the last 5 years, we only had 2 years of stable business and we had 3 years of COVID business. Mm-hmm. So in the last 3 years, they've only averaged, what is that? $1 billion in profit over, so 205, I mean, it's not very good. Now, $3 billion in profit over the last 5 years, over the last 3 years, it's $1 billion a year, when in the previous 3 years, they'd average around $11 or $12 billion. So you've got to remember this when you're looking at companies. So if you're new to this channel and you're a little bit struck by how detailed I'm going here, I'm Paul, I'm a value investor. I don't take 1 year of data or 1 quarter of data or anything short-term to make my decisions. I look at long-term information. I look at our 8-pillar process, which you'll see very shortly, and try to use that to tell a story and to tell me what questions to ask about the company. So let's go to our 8 pillars real quick and figure this out. I use our 8 pillars as a 500-foot view to analyze a company and help me determine what questions to ask for that company. I believe the quantitative aspects of the company, which are the numbers, will help drive my decision to go further and do more assessment or not, and what questions to ask going forward. My goal is to find situations in which the company is selling for drastically below where I think the company is actually worth. This involves waiting for the market to kind of change its view on the company, but my goal is that they change the view erroneously, and I can buy $1 for much less than that. So if that makes sense to you, subscribe to the channel, keep watching this video, and watch all of our videos in the future because it's exactly how I look at every type of investment, whether it's a stock or real estate. Because remember, the more you learn, the less you will fear. This has been applied to everything in your life. It especially applies for money. So let's go look at our 8 pillars for Disney. Wow. Yikes. So what was that, Mo?
Yikes.
There's a lot of X's, guys. X. I mean, everything's bad. The only thing that's big is revenue growth. Now, the good news is that revenue, so look at the 5-year free cash, look at the 5-year free cash flow. It's $4.5 billion over the last 5 years. Let's go look at the pre-COVID numbers of free cash flow. So we go to our cash flow statement. We scroll down and we added this line to our software. This is the last 3 years. 347, 1.3, 1.5. Here's the previous 5 years before then, where they had a lot less revenue. 7, 7.7, 7.7, 10.7, 8.7. Do you see this? It's a drastically different story. I am not focused on this. I'm going to focus on them getting back to these levels, okay? And Disney Plus, was Disney Plus even around back in 2016, 17, 18?
No.
I'm getting shaking the head no here in the studio. It wasn't even around. And this is very high margin business. So this is what I'm going to factor in going forward. So if you take our average free cash flow and adjust this to what, $9-10 billion, if not higher, it drops this long-term liabilities way further down, right? They've issued a lot of shares. Why do they issue shares? Probably to fund losses along the way. Because there are two ways to fund a business, debt or equity. They chose to do equity. Now, does that mean Disney is a buy or not a buy? I don't know. What we're going to do is we're going to use the stock analyzer tool. This tool is used to make assumptions about the future because every investment is the present value of all future cash flow. And if you're like the thousands of people in our community, they're always going to repeat, remember what Uncle Paul says, every investment is the present value of all future cash flow. But we don't know the future. Our job is to make assumptions about the future and be conservative about those assumptions. When I'm conservative about my assumptions and it spits out a price, my goal is to buy a stock when it's less than my end value. So Mo, you had a question. Go ahead and ask.
Does the dividend bother you?
All right, so Mo's asking if this $1.6 billion dividend bothers me. Now, here's why he asked that. Most people see a dividend and think, oh, great, it's a dividend. What Mo and I do as value investors is we want to make sure the company can afford the dividend. So last year, they had $1.55 billion in free cash flow. So they wouldn't really be able to cover that through free cash flow. In the last 5 years, they've averaged $4.5 billion. But remember, and that's very ample. If it's less than 50%, I'm comfortable to go forward. But remember, look at this business before COVID. Let's even eliminate all of this. Free cash flow, 1.6 could easily be covered easily in this. And my guess is Disney will probably increase their dividend as business gets back to normal and their cash flow net income get back to normal. So let's go use our stock analyzer tool to figure things out. So we're here on stock analyzer tool. First things first, I can do between 1 and 20 year analysis on the company. I'm going to do a 10-year, just my go-to on everything. As you can tell right here, guys, it asks for assumptions low, middle, and high on revenue growth, profit margin, and free cash flow margin. Then it asks for my ending PE and price to free cash flow multiple at the end of 10 years, and then my desired annual return. I want you guys, if you're new to this, or even not new to this, and this always confuses you, and you have the software, please rewind this as many times as you want so I can explain to you in more detail why I'm making these assumptions. The more iterations you get, the more comfortable you'll feel. I use this software completely when analyzing my companies. So let's look at this. So revenue is back up. So I'm going to be conservative and call it 2, 4, and 6% revenue growth. Is that too conservative? I don't know. I haven't done any research on Disney. My goal is to put lower numbers but be realistic, somewhat realistic to say, could I see 2%? Sure. Could I see 6%? Sure. That would involve them doubling their revenue in the next 10 or 12 years. But still, I can see that some sort of wave happening, especially as streaming becomes more and more important for Disney and they're more involved with sports, which is going to drive revenue for advertising. Now, profit margin. Now, remember, this profit margin, I'm going to focus more on the 10-year number because their profit margin was really affected in the last 5 years by COVID. So I'm basically going to ignore these. And I want you to remember that. When you watch more videos and think, geez, Paul's being too conservative, I'm going to give them credit where credit's due. I think historically they've done about 10%. So I'm going to do 9, 10.5, and 12% revenue growth. Profit margin. Free cash flow, guess what, guys? I'm going to do the exact same thing. Because over long periods of time, free cash flow and net income should be very similar, especially for a company as big as Disney. And then finally for PE. Now remember, this PE and price to free cash flow are super high because net income and free cash flow are super low, right? So when you have price divided by earnings, as you drive down earnings because of whatever fluke COVID happened, it's going to make the entire ratio go up. So like if this is 100 and this is 10, it's 10. But if all of a sudden earnings drop to 5, this becomes a PE of 20. So a company like Disney, there are two ways to figure out PE and price of free cash flow. I factor in moat and growth potential. The moat of all moats, Disney.
Yeah, that's true.
I could give you $100 billion and you ain't going to mimic Disney. That is a moat. Like literally an epitome of a moat. Growth? Not so much. Why? Because they're so big, right?
Huge.
So I'm just going to stick with my typical 13, 15, and 17. Now, 13 might be low, but they still have some things to get through. I still want to make sure they get to their levels of where they want to get to in profitability. So I'm probably being conservative, but either way, that's where I'm going to stand at. And for my desired return, guys, I'm going to 12.5%. Why 12.5? Well, I can get 9 or 10% return just by buying a long-term ETF. So I want to give myself some sort of margin of safety and give myself a reason for buying these individual stocks. I hit the analyze button. And guys, below, when I scroll down below, there's going to be 6 numbers. 3 are going to be based on a low, middle, and high based on earnings. And 3 will be low, middle, and high based on free cash flow. If it's all green, it does not mean go out and buy this company. If it's all red, it doesn't mean go out there and short the company or avoid it. If it's all green, go make sure your assumptions up here are correct. That's what I want you to do. If it's red, but pretty close, add it to your watch list. You'll be able to add it to your watch list above very easily. And then when it hits the price target, you'll get a notification on your app, on your email, and on the website telling you, hey, come look at the stock. It just hit your price target. And after we're done with this, please stick around if you're interested in trading, because Mo will show you how to make money off Disney no matter where the fundamentals are just by reading the charts. It's awesome. It's a lot of fun. I do trading. I think it's a great way to make money no matter which way no matter what the fundamentals of the market are. So I hit the analyze key, go down below. All right. So 40 low, 84 high, 60 in the middle. This is probably a little too conservative, but again, I'm going to add it to my watch list at, I'm probably going to go 90. Because I think I'm being too conservative there. Notify me. And Mo, take it away. Show people how to make money trading.
So guys, today they reported earnings, and you'll notice that you had this one big jump. Let's make this really big. You notice you have this big jump up. So one of my biggest rules, when you have a stock that trades earnings on the day of, do not trade that stock. Let everything settle down. This thing could easily fall right back down tomorrow. It could easily move up tomorrow. It could easily just stay right in the middle and do nothing. So let earnings happen. Let them calm down. Just because a stock reports good earnings doesn't mean it goes up. Just because a stock reports bad earnings doesn't mean it goes down. It's a total crapshoot. But right now, the thing that I'm focused on is this overall trend. If I can get the red line and yellow into the sweet spot like this, and the stock price keeps going up for me, say that we don't have to worry about this gap, then I really have something here with Disney. So you people that really love long-term trading, I would definitely pay attention to this thing, because today was a great move to continue the trend. Now, with that being said, for those of you that don't want to look at a long-term chart, come over here to a swing trading chart. You could have a friend that's going short on a stock and a friend that's going long on a stock based on what chart you're using. Try to trade this thing right down to the 100-day moving average. You got about $9 to play with in here. You can even trade it even lower, below the 100-day moving average. Guys, learning to go short is going to be something that is very, very important for you going into the future, especially if we're going into some type of market correction. Stocks go down a lot faster than they go up. Shorting is where it's at. You need to learn how to do it. Come and join me in the Bid and Ask Nation if you want to.
Thanks very much for watching the channel. Please subscribe to the channel if you like what you see, and watch the next video, more detailed analysis of our 8-pillar process, how you can learn to use it to evaluate your companies. Thank you very much.